What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit notification bell so you don't miss future videos. So according to ETF Delta, the news came out that YieldMax has filed for several reverse splits. A 1 for 10 with Ulty, CONY, MRNY, AIYY, CRSH, DIPS, and FIAT, and also a 1 for 5 reverse split with TSLY, OARK, YBIT. That's the only Bitcoin one that did a reverse, XYZY, and ABNY. So they also provided an example. All right, the split date is in 2 weeks. So if you had 1,000 shares of Ulty, you get 100 shares. And then you have a share price, okay, right here, of $4.02 share price to $42. And then you have a 6-cent distribution to 60 cents. So you're going to generate $60 either way. So let's go over this, why a reverse split is always bad. So let's check that out right now. So since inception, it started off at $20 in March 2024. Then it used all these synthetic type call ETFs. You know, it wasn't actual holdings. Then in March and April, they started adding individual stocks. So the NAV was actually decent, and the NAV was actually going up. But now, since the market it appears to be a stock market correction, Ulty is at 421. So again, if you had 1,000 shares, you're down to 100 shares, and you're starting to see from here, 545, right here, let's just say April 4th, 545 to 421. So there is a decrease in the price. Now, what a lot of companies will do for a reverse split is make it more attractive to people and say, wait a second, the price is really good, but it is decreasing over time. So a reverse split basically saves the holding. Now, you have the same amount, but what happens is when you get a reverse split, this is going to go right back down. So when you have 1,000 shares and then you go to 100 shares and then you see this, a repetitive thing, and then what? A 10 for 1 reverse split again? So you get, okay, so let's just say 1,000 to 100, and then we do another 10 for 1 in a few years. This isn't even 2 years that this happened. Then you have 100, then you go to 10, then you go to 1. But wait, my distribution. But the problem is, if you notice with the YieldMax distribution, and I'm going to show you a mirror image of what Ulty reminds me of with this reverse split. This reminds me of USOI. So USOI was a high yielder, and it did a reverse split. Let's just say in the past year, it has decreased over time as well. So now you're seeing a significant drop with USOI ETF, like what happened with Ulty, but then it's going to keep on decreasing. But the one thing that has Ulty going for them is it actually has stocks within its portfolio. But I'm going to be honest with you, it is poorly managed, and that's a huge problem with that. Now, you're going to see a lot of influencers, and I don't want to call myself an influencer, I'm just telling you my story, of people who go all in with Ulty, and they think that Ulty is the ultimate answer, or these YieldMax ETFs. But the problem is, if you're going to retire on dividends with Ulty, or MSTY, because MSTY looks like it's dropping, or these other ones, you have a serious problem. Because we're going to go over the trends of distribution with Ulty if you think you're going to retire on passive income with Ulty. Now, here's the thing on their website. Now, don't get me wrong. I'm going to show you better alternatives than Ulty shortly with the YieldMax ETFs that I own. But here's the thing. Okay, yes, they promise weekly income potential, a diversified portfolio, upside participation. But there's a few things going on. Now, you get a reverse split. Now, let's just start in, let's say August, because I went in and I got out at the right time. And I actually, it looks like with my numbers, I made somewhat of a profit. But the holdings got worse and worse. And it was like, whoa, okay, so it looks good, and then it's not good, and then, whoa, what are they doing? So you have to rely on somebody managing this. But look at the distribution. It was at 10 cents. It was beautiful. The NAV was good. Then you're at 9 cents. And then you drop to 8 cents, and then you drop to 7 cents, and then you drop to 6 cents. So the way it is managed, unfortunately, I mean, you hit 11 cents at one time. Now you see the NAV going well when it was managed better. So see this? 5 cents and 4 cents. And then 10 cents. Okay, that's when it was mostly the synthetic calls. But you notice that they start showing their distribution now on their website. So 9 cents, and then 6 cents. So let's think about this now numbers wise. I got 1,000 shares as he provided. Then we have 100 shares. Okay. And then it does another reverse split, and then great, I'm making 10 cents, then 9 cents, then 8 cents, then 7 cents, then 6 cents. What are you going to do when you're going to try to retire when you're in your 60s? Are you going to keep on reinvesting? You're going to keep on reinvesting? It appears with even with the numbers, okay, yes, you can say since inception it's done well. That's a pretty good fool's gold lie. But thing is, a lot of people say, well, look at SEARS. SEARS did fantastic too. Well, SEARS ain't around. SEARS lost a lot of money. And I've heard people say over the years, well, look, since inception now it's done. SEARS is done. People dropped out of SEARS. They're a joke. So you're looking at these numbers. It's just not good for retirement. And by the way, I woke up very early to do this video because this is huge. So the numbers are trending down, the numbers are trending down, the numbers are trending down. You get a reverse split, then the numbers trend down, the value trends down, you get a split, you lose in value, it's poorly managed. But there are better options that with the YieldMax ETFs, the ones that I own. I'm not going to completely trash their ETFs. I think certain ones are bad. And, you know, if they tell you, well, if you do this since inception, I really think they're saving grace. And I think what YieldMax should do is actually adapt with these portfolio options in income ETFs. Yes, there is a high expense ratio, but there's better chances of not having a reverse split and maybe using that income, which I use their income to buy dividend growth stocks. So I'm going to go over these four better ones real quick. There are some of them that actually are doing better, and I'm going to go over some of the holdings. So CHPY, LFGY, SOXY, and GPTY. Now, I don't have an opportunity to own SOXY because of it not being on M1 Finance. And it does have a slight high expense ratio, but so does the NEOS. NEOS has a high expense ratio too with BTCI. But since inception, okay, let's just do the max. CHPY has been up 13.34. LFGY has been down, okay, 33.43%. but it fluctuates. SOXY's been up 16.99%, and GPTY has been down 1.49%. So what are in these that make these better? I'm going to go over them. But first, I'm going to go over the YieldMax Semiconductor Portfolio Option Income ETF. Weekly income, diversified portfolio, and growth opportunity. It seeks to generate income without also, again, I'm motor mouthing, I'm highly caffeinated, and I have my Invisalign in, so try doing all three of those at the same time and doing a speed run. So the strategy seeks to generate income while also capturing capital appreciation potential from a focused portfolio of semiconductor companies. So we have a distribution rate of 41.01%. You'll see return of capital 100%. So right here, you have an expense ratio of 0.99%, but look at the distribution, 40 cents, 39, 39, 38, 43s, 45s. One week you hit 57 cents. So this top 10 holdings, these are actually holdings, Broadcom, NVIDIA, Micron Technology, AMD, Qualcomm, Taiwan Semiconductors, Intel, if they get their act together, and Applied Materials. Those are some really good ones. So they do have some very good holdings in them. And this is why I own a lot of shares of CHPY. And I'm going to jump to the next one. Next one, I'm going to jump to LFGY. It's the Crypto Industry and Tech Portfolio Option Income ETF. So again, growth opportunity, diversified portfolio, weekly income potential. Distribution rate, 80.89%, return of capital, 4.08%. So now, what is in it? And again, you have a 0.99 expense ratio. You got 50 cents, 43 cents, let's just say an average weekly as of right now. That's not guaranteed, of course. But their top 10 holdings, you got Coinbase, you got IBIT, Strategy, oof, that one's taking a hit. Robinhood, which HOOW I'm heavily invested in. Hopefully they get better. Maybe, I'm going to be reinvesting a little bit back into HOOW. You got Mara, the iShares Ethereum Trust, Block. Okay, so again, some of these, and if Coinbase goes back up, now this one's a very volatile one. That's why it's a little bit down. But again, I have shares in that. Bitcoin hopefully will get back to normal. They have a lot of cash in it, and hopefully Coinbase will get back up there as well. People are actively buying and selling crypto, and usually they get a fee for that if you're not part of their membership. So I'm not one of their members, so I have to pay a fee anytime I buy Bitcoin, which I did buy some Bitcoin this week. Let's jump to the next one. This one, I'm very jealous that M1 and upset that M1 Finance doesn't have them. The YieldMax Target 12 Semiconductor Option Income ETF. This might be their best one, honestly. Targeted income, diversified portfolio, and growth opportunity, a distribution rate of 12%. So again, 0.99%. So look at its distribution, 52, 48, and 62. But again, this is going up. You're starting to see things go up, which is nice. Now, if this one goes up, hopefully the distribution will go up. That's the way it looks at. But look at these holdings: NVIDIA, Taiwan Semiconductor, ASML, Broadcom, Micron Technology, AMD, Intel, Applied Materials, and Qualcomm. So they have some very, very good holdings for their top holdings, which is very impressive. And I'm going to jump to the final one. This one's one of my favorite ones as well. GPTY, the YieldMax AI and Tech Portfolio Option Income ETF. Again, weekly income, diversified growth opportunity. Distribution rate is 35.73%, but okay, you have a 0.99 expense ratio. You got the 30s and 40s, so that's not bad. It's top 10 holdings: NVIDIA, Palantir, Intel, Alphabet, AMD, Apple, Microsoft, Snowflake, Taiwan Semiconductor, and Broadcom. Those are some heavy hitters. And again, NVIDIA's up there, Palantir's up there. I do think Palantir's way overvalued. You have Intel and Alphabet. Eventually, hopefully, Intel will get back up there. I mean, they have that chip factory that needs to get going in Columbus, Ohio. So that's it. these four, I think, are way better alternatives than Ulty. I don't see a reverse split happening with these companies. Now, I think LFGY can take a big hit. It may take time to recover based on its portfolio, but CHPY, SOXY, and GPTY are really good YieldMax ETFs. So not all the YieldMax ETFs are bad. I think these ones are really good for potential long term. I would feel more comfortable retiring on passive income with these ones versus Ulti. So I just wanted to be very clear with you guys on, reverse splits are not good. But the one thing that helps and could help Ulti in the long run is if they do a reverse split and they have good holdings that stabilize the NAV. Now, I'm sure people would be okay with an 8-cent distribution the whole time if the NAV was stable. Everybody would be. I don't think anybody would be upset with that. But the way it's designed, it appears to be designed to failure. Now, can they get their act together and manage it better? Yes, I think there's potential, but right now, a reverse split is not good. So what I hope what they can do in the long run is make more portfolio options income ETFs. I've emphasized that. I don't believe in those individual ones. I like the round hill ones a little bit better, and they're more of a risk. So I'm going to be honest with you. People say, well, this, and this. The numbers speak for itself. I'm not going to rely on emotions. You have to rely on numbers and rationality when it comes to investing and retiring and on passive income. I'm going to be honest with you. I enjoy it more receiving dividends from, my Microsoft, my Nike, my Iron Mountain, my Coca-Cola, my Pepsi, my Bank of America. I appreciate that more as compared to these weekly options income ETFs because I know I'm going to get a raise usually with these dividend stocks. They usually hike their dividend, and there's potential for growth for some of these ones. I mean, this is why I love Broadcom and invest in Broadcom and all them and Taiwan Semiconductors. So that's what I really want to sum up for. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. I will have a video for you tomorrow. Take care and have a good one. And I'm going to jump to my disclaimer. So as a reminder, this is a disclaimer. Do not use my YouTube channel for any form of financial advice. It's strictly for entertainment purposes only. Investing is a big risk. You can gain money, you can lose money, so be aware and do your due diligence. Go to a financial advisor for financial advice. Go to a tax advisor for tax advice. You shouldn't be buying things because I buy things. My situation is a lot different than yours. So I'm going to be very clear with you when it comes to investing. I can take a hit. I'm not sure if you can in certain situations. That's why I tell you to go to a financial advisor. And when you're doing your taxes, go to a tax advisor. You have to do your due diligence. I'm going to say that again. Do your own research, do your due diligence. You can lose money when you invest, so be aware. Take care and have a good one.